As a mutual fund distributor, if you are looking for insights to build a performance-driven portfolio for your client, then this video can be useful for you. In this video, I'm going to discuss with you what all things you need to keep in mind before suggesting a mutual fund portfolio to your client. What all data and information you need to gather, how you need to build a portfolio depending upon various parameters, and what all things you need to keep in mind when you are giving your suggestions to your client regarding investments. Hello everyone, I'm Shobhit. I'm a fin-based growth expert and founder of fin-based growth club. We are an aspiring community of new age mutual fund distributors who are determined to change how India invests. So most of the time the query which I get is whether I should give a large cap fund or a mid cap fund or a small cap fund. But this session I'm going to dive into a very different kind of approach. So the first thing which we need to do whenever we are building or we are in the process of suggesting a portfolio to our client, that we need to gather data from our client. What are the data we need to have beforehand with us so that we can suggest the right approach to investments? The first thing which I want you guys to look into is the financial literacy of your client. And by that what I mean, you need to understand how deep or how well he is aware of the various financial concepts and insights. So start gathering those information, whether he has history of financial instruments investment or not, how well he is aware of the risk involved in investments, whether he is aware of what is savings or investments, and so on and so forth. Other insights which you need to gather is the taxation part, whether he's into higher tax bracket or he's into lower tax bracket, what is his income source, whether he's dealing in cash or not. Those insights also you need to be aware of. Then you need to be also aware of his cash flow. This means what? You need to dive deep into understand that whether he's tracking his income on expenses or not. If we are not aware of the cash flow of our client and we start his investment journey, believe me, more often than not, it is going to go for a toss. So you need to spend a lot of time to make him understand how much he is earning, how much he is spending, and what can be devoted for his future financial goals. The most important thing which you need to understand from your client is what are his needs and aspirations. Now, please understand, investment is a habit. And if until now he is not in that mode of investments, or he has not that built an habit for investment, first we need to create that habit. And how you are going to create that? In case you are able to align his aspirations or desire to certain financial goals, then I think we are on a good path. So we need to dive deep into with him so that we can understand what truly he desires, whether he truly loves going for vacation or buying a car or anything which can be fulfilled with money. Once you understood his desire, and then if you are able to help him in getting those aspirations done through a structured financial investment approach, believe me, we are building a long-term habit to our client, and that is going to help your client as well as you as a mutual fund distributor in a long way. So these are concepts you need to understand and keep in mind when you are gathering the data. Now, once you are clear on that, let me talk to you what should be the approach for you to data gathering. What all things you need to be keeping in mind. So the first thing which you need to understand, my dear friends, is whenever we are talking or discussing with our client from the point of view of understanding the needs, aspirations, desire of the client, is to make sure that we are going to be making our client talk to us. Now, most of the time what we do, we want to show ourselves as a learned guy, as a guy who knows each and everything regarding investments, and we keep on talking every time. We want to show them how we are well equipped. But we need to understand it is not about us. It is about our client. We need to understand what he really wants to invest for. So generally I give what insights to our community member is you need to follow a 70-30 rule. Now what this means, 70% of the time whenever you're interacting with them, they need to talk, and only 30% of the time you need to talk. So you need to dive deep into as what they're really looking for. So for that, what you need to do, you need to ask the right questions. You need to give them right triggers so that they can open up to you, so that they can tell from their heart what they really require. Okay, so you need to be very, very aware of the fact that it is not about you, but about your client. You need to be also getting a lot of information regarding their backgrounds, from where they are coming from, what are their parental history regarding savings or investments, how well they are equipped, what kind of investments they are comfortable of, and so on and so forth. You need to be also be making aware whether they have some good or bad experience with various financial institutions, and this is also going to be helping in a good way to get our client on the right path of investments. So these all things you need to be making your client tell you, and that can only happen if you have structured your questions well. So our main job as a mutual fund distributor is ask the right question to our client without intruding in their personal life. So always keep in mind, get the information as much as possible, not more from the point of view what purpose or investment they want to do, but making them aware that how you are going to be helping and what all things they are aware of or they are not aware of. Okay, so this is the way you need to approach when you are going to gather data from your client. Now let's talk about how you are going to build a portfolio, which we all are looking for. So when you want to build a portfolio for a client, some certain thumb rules you need to follow, okay, which I call as a rule of elimination. So the first thing first, you need to understand that if your client is having any negative experience with any brands, you need to avoid mutual fund schemes from those brands. However good the performance may be, but your client will be itching if you are going to suggest schemes from those brands. And that can only be you, and that can only happen if you have spent a lot of time and understood your client's financial history, understood his experience, and so on and so forth. Then you need to understand the risk appetite of your client. Now, risk appetite means you need to understand what kind of risk your client is ready to take or can he take. Okay, there's a huge difference between both of them, and we need to understand that. So my request to you would be, in case your client has enough cash flow, we don't necessarily require to give him a huge equity exposure, which can be highest risky investments asset class. So what you need to do, if your client is having enough cash flow, even with a lesser risk portfolio, he will be able to meet his financial goals. Don't just show them that what kind of portfolio you can build, which is going to give you 20-25% return. What you need to understand that we want our client to reach their financial goals. That can happen even without taking unnecessary risk if he has enough financial resources. So understand that, and then accordingly you need to give various asset classes to him. So this is the one part, understanding the risk appetite. Now with the time frame also, you will be able to eliminate lot of choices which we as a mutual fund distributor have. So generally whenever you're interacting with your client to understand their requirement, I would like you guys to bucket their financial requirement into 4 time frame. One is year or less, another 3 years or less, another is 5 years or less, and then 5 years or more. If you are able to bucket their financial requirement in these 4 time buckets, I can give you a asset allocation for them. So in case your client has a requirement of a year or less, I would highly recommend that you should be looking at arbitrage funds for parking those money instead of liquid funds or debt funds. Why? Because arbitrage funds are going to give you arbitrage in terms of equity taxation, and even though if it is going to give you equivalent or little less return, those will be highly tax efficient, and that would be a good way to go. In case you are going to suggest them investment 3 years or less time frame requirement, then I would suggest it should be 30, 60, 10. 30% should be equity, 60% should be debt or any mutual fund schemes which are having a risk profile of a debt fund but a taxation of equity funds, and 10% can be given to gold or international investments. And in equity as well, please confine your suggestions to large cap or flexi cap funds. We don't have to go into small or mid cap fund. In case you are going to suggest them for their financial requirement of 5 years or less, then I would highly suggest that you can bifurcate your suggestion into 50% equity, 30% debt, 10% in gold, and 10% in equity, 10% in international investments. Here you will have more headroom to suggest schemes which are going to be helping your client in diversifying portfolio in terms of asset classes and reducing the risk and increasing the risk reward ratio. Please understand, when we are talking about 30% debt, it doesn't mean necessarily that we need to give debt funds only. There are other routes as well through which you will be able to give him enough debt with equity taxations. Those insights you need to keep in mind. Generally, I find that the mutual fund distributors are only designed to think that means that mutual funds, but you need to be making aware yourself and your client as well that debts should have a 3 years or plus time horizon. In case they are going to withdraw in between, they are going to draw higher taxation. So if you are going to be smart enough, you can reduce the risk profile as well as increase the tax efficiency by helping your client with. Whenever you are suggesting a portfolio which is going to be of 5 years plus, then I would highly recommend that you should be giving 65% equity, 25% debt, and 10% can be given to international investments. Now here you will have more headroom, if I may say, where you will be suggesting, let's say, mid cap, small cap, some sectoral funds as well. So these all things you need to keep in mind according to the time frame. I have given you some benchmark numbers in terms of various asset classes where you need to dive into, and that is going to be helping you in giving a proper asset allocation according to time frame. Now, the other thing which I would like to discuss with you here is how you should be avoiding and what all things you should be avoiding. The first thing which you need to keep in mind is avoid selling the performance. Now, I have seen mutual fund distributors are going to carry the performance of all the mutual fund schemes, and they are going to tell the client that this scheme has given this return, this scheme is going to give this return. And then if you are going to give those numbers to your client is always going to remember those numbers and they are going to chase you. And that is not good for us. If the fund manager of those schemes are not ready to commit those numbers in the future, how we as a mutual fund distributor are going to commit those numbers? It is highly unlikely. That's why don't sell schemes, sell portfolios where you are going to take the attention of your client from a particular scheme to a holistic approach to investments. So once you are clear as how you are going to build a portfolio, let me give the last piece of advice that what things you need to be keeping in mind when you are suggesting a mutual fund portfolio to your client. And the last thing which I would like you guys to do is always keep in mind that you need to make it simple. You don't have to complicate the thing. You don't have to give too much information to your client. Now, please understand, if you are going to give 10 funds, 10 schemes, and so much knowledge to your client is going to have a decision fatigue. Why? Because he will not be comfortable, or he will not be going to go and research for all the schemes which you are going to suggest. So I want you guys to make it simple. Don't give too many choices, because ultimately it is going to lead to decision fatigues. And once it is going to lead to decision fatigues, it is going to delay the decision making process, and it is not going to help either your client or you as a mutual fund distributor. So what you need to keep in mind, you need to understand that client is not buying schemes here. Client is buying you. So you need to be very confident the offering which you are going to be presenting to your client. Once you are able to convince that you are the guy who is going to manage the financial affairs of your client efficiently, he is not going to look into the nitty-gritties. So always be confident, don't give him too much options, and I think it is going to be helping you as well as your client meeting their financial goals and building your business in the right way. So I hope I have given you some blueprint as how you need to be approaching the portfolio building aspect whenever you are suggesting any investments ideas to your client. In case you love the content, I would love you guys to hit that subscribe button, give a thumbs up so that whenever we have something new to share, you guys will be first one to know. Thanks for watching. I'm going to see you next time.